Welcome back to Morning Markets on Friday the 4th of August. Yesterday, the Bank of England raised interest rates for the 14th consecutive time by a level of 0.25%, bringing the current rate of interest to 5.25%. So let's take a look at the votes cast by the Bank of England. Here in the UK, a majority vote is required by the Monetary Policy Committee in order to change interest rate policy. Yesterday, the votes were 6-3 in favour of a 0.25% increase. For those opposing, 2 of the members were voting for a 0.5% increase, and the 9th member voted for rates to remain unchanged. So where are we relative to inflation targets? Well, if we look at headline inflation in the UK, it's 7.9%, and this has been taken down from its highs of 11.1% in October of last year. Core inflation, which removes energy and also food, is currently at 6.9%, and this is really struggling to ease. In fact, it's very close to the most recent peak of 7.1%, which was only struck in May. Our current annual rates we're a long way from the Bank of England's 2% target. However, if we look month to month, then we're seeing that the rate of change is closer to 0.1%. And this is encouraging because it's demonstrating that momentum in terms of upward price growth is starting to ease. And this gave the Bank of England confidence to reduce the rate of increase to 0.25% after they surprised the markets with a 0.5% increase in June. But what about the projections? Well, the Bank of England themselves have also revised their economic projections with a view that inflation here in the UK will ease to around 5% by the end of this year, a quicker decline than they'd anticipated back in May, and return to the 2% target by around the second quarter of 2025. To get there, they believe that interest rates will need to get somewhere close to 6%, so another 0.75% from here, and stay roughly around that target for the next number of years. To give you a feel for that, over the next 3 years, they expect interest rates in the UK to average around 5.5%. What was the market reaction, and what does this mean for portfolios? Well, for UK government bonds, those which are shorter term to maturity and therefore more sensitive to interest rate expectations, and sterling, they were all relatively well behaved. We did see bond yields push out slightly through the course of the day, but what this is demonstrating is the interest rate change was largely expected by the markets. Thank you very much for watching. We look forward to bringing you up to date next week here on Morning Markets.